Hey everyone, Marcus Millichap just released the 2025 Multifamily Investment Forecast. This report offers insights on major national trends, including the economy, capital markets, multifamily performance trends, and the investment outlook. In addition, this report offers a drill down on 50 major markets with graphs, data tables, and forecasts. We also provide a ranking index based on the one-year local multifamily performance outlook for the 50 markets. And in this week's video, I'm going to highlight the 5 markets that topped our list. But first, I want to focus on one of the key components that drives multifamily, and for that matter, most commercial real estate demand: job creation. And for 2025, we're predicting steady but modestly slower job creation than we saw in 2024. In total, we expect the United States to add 1.8 million jobs this year, down from the 2.2 million positions added in 2024. The slowing pace of job creation reflects the higher interest rate climate driven by the Federal Reserve's effort to drive down inflation. But we still expect the Fed to achieve a soft landing, with unemployment remaining stable near 4%. Now, with respect to the multifamily outlook, one of the greatest headwinds to performance has been the wave of multifamily development. In 2024, about 520,000 new units were delivered, and we expect completions to scale down to about 410,000 units this year. And that will help support a modest tightening of vacancy in 2025, taking the national vacancy rate down to 5.1%. One of the forces that will help put downward pressure on vacancy is the high cost of homeownership, which, when combined with elevated interest rates, has kept the monthly mortgage payment on a single-family residence elevated. This has restrained the loss of tenants to homeownership, as the affordability gap, the spread between the average apartment rent and the monthly payment on a median-priced home, is near a record high. This has supported above-average apartment lease renewal rates, and lease renewals tend to deliver higher rent growth than new leases. But with so many new apartments coming online over the last year, the use of concessions has surged, particularly in Sunbelt metros where construction has been concentrated. So, on a macro basis, we anticipate modest strengthening in the multifamily market over the course of 2025. Before I shift to the top 5 markets in the Marcus Millichap 2025 index ranking, I want to mention something. For the rankings, we did not factor in the risk of natural disasters. It's just too hard to predict where they'll hit or how big the impact will be. So, coming in at number 5 in the Marcus Millichap Multifamily Index is Houston. Houston had elevated development last year, but the inventory growth was more modest than many of the other Sunbelt markets, reaching just 3.3%, and development is expected to fall to just 2% inventory growth in 2025. And the 2% job growth forecast for the metro is one of the strongest in the nation. We expect the vacancy rate to remain stable and forecast the market will deliver 3.1% rent growth in 2025. In addition, although Houston has a very diverse economy, the metro should get a boost from the anticipated pro-energy policies of the new Trump administration. The number 4 market on the 2025 multifamily investment forecast is Las Vegas. Although Las Vegas has historically been prone to overdevelopment, new additions were more modest this cycle, with inventory increasing by just 2.3% last year. Job creation in Las Vegas is expected to outpace the national average with a diverse mix of employment. The strong employment market will support 3.3% rent growth as the local economy diversifies and strengthens. The market ranking 3rd in our 2025 index is Orlando, which we expect to boast 4.5% rent growth this year, the strongest in the nation. Although the metro had 5.2% inventory growth last year, we expect construction to ease considerably in 2025 with the addition of 8,000 new units, about 2.8% inventory growth. That should support a 20 basis point decline in vacancy as the market adds 24,000 new jobs. Coming in at number 2 this year is Dallas-Fort Worth, last year's number 1 ranked metro. Dallas-Fort Worth continues to navigate a construction boom. After adding 44,000 new units last year, we expect another 36,000 units to come online in 2025. But offsetting this enormous volume of new development is the addition of about 65,000 jobs last year and a comparable level of additions this year. Although we expect vacancy to nudge higher in Dallas-Fort Worth, the market should still generate 2.2% rent growth. One of the reasons the metro ranks so highly in our index is because the expected economic growth of the market will outpace construction in the coming years. The pipeline of new construction is thinning rapidly. And now, the top market in the Marcus Millichap 2025 index is Miami. We expect vacancy to decline by 10 basis points in 2025, despite the addition of 8,100 new units generating 3.6% rent growth. Miami and the Southeast Florida region as a whole will boast some of the strongest rent growth in the nation, supported by still strong in-migration and job creation. So those are our top 5 markets in our 2025 ranking. If you'd like to download a copy of the 2025 Multifamily Investment Forecast, it's available on our website, marcusmillichap.com. Hopefully, this in-depth look at the market will help you keep your eyes on the horizon.